Global geopolitical realignment happens rarely. The world is living through only the first such realignment since the end of the Cold War. If history offers any guide, we should expect profound and lasting economic changes, even if we cannot see them clearly yet. What are the early signs that the intensifying rivalry between the unipolar and the multipolar world order will be upending the world economy? Why do they tell us to expect an increase in the frequency of recessions? How can we tell who will be the winners and who the losers in the brave new world? Warren Buffett famously said that only when the tides go out when you can see who's been swimming naked. Which is the most important economic attribute that will separate the wheat from the chaff? Hi, I'm David Wu, a former IMF economist and Wall Street strategist with a 20-year track record of making actionable predictions about the big story shaping our world tomorrow. The fall of the Berlin Wall in November 1989 ended the struggle between capitalism and communism and ushered in the age of globalization. Within a decade, countries like China, India, and Brazil abandoned central planning and joined the global marketplace. The result, of course, was a boom in global trade and cross-border investments. Between 1998 and 2013, merchandise trade as a share of global GDP grew from just 30% to 50%. Globalization was generous to asset owners. In the 30 years after the fall of the Berlin Wall, S&P 500 rose by 1,635%, emerging market equities by 458%, and 10-year German government bonds by 584%. And Wall Street was not the only beneficiary of globalization. According to calculation by the World Bank, in the 30 years following the fall of the Berlin Wall, the global poverty headcount ratio declined from 35% to just 10%. And the income of the bottom 40% of the world population increased by close to 50%. Globalization might have made the rich even richer, but it also lifted 1 billion people out of poverty. No doubt some people became worse off because of globalization, but for the world as a whole, it brought about more welfare gains than welfare losses. About that, there is no shadow of a doubt. Whether globalization was a good thing or not, right now it certainly feels like it's history. This is because 30 years after the fall of the Berlin Wall, the world is fragmenting once again. This time, the fragmentation is not along ideological lines like during the Cold War, but along wallet size. What do I mean by that? In a nutshell, fragmentation right now is between wealthy countries and not so wealthy countries. The conflict between them ultimately comes down to this: wealthy countries feel threatened by the not so wealthy countries that want to have a bigger seat at the table. Lately, both camps have been busy beefing up their respective sides. NATO, the military alliance of rich countries, added Finland to its club earlier this year and is leaving no stone unturned trying to get Sweden inside the door. NATO has been in talks with Japan about opening an office in Tokyo to facilitate dialogue with Asia-Pacific partners. Meanwhile, last week, BRICS added 6 new members from the Global South. This club of the not-so-wealthy countries can now boast of commanding 36% of global GDP, compared to just 30% of the G7, the club of wealthy countries. It is ironic, but telling, that most of the new and old members of BRICS are former colonies of the rich countries. For example, Egypt, India, and South Africa were once British colonies. Brazil was a Portuguese colony. Ethiopia was an Italian colony. Argentina was a Spanish colony. Japan had colonized a big part of China before and during the Second World War. Only 2 years ago, the idea of a political realignment of the world between the former colonizers and the colonized would have seemed implausible or even laughable. But today, the trend looks unstoppable. While the rich countries are set to spend more than $1 trillion this year on defense, 17 more countries have officially applied to join BRICS, with another 50 having expressed an interest to do so. What will be the consequences of this new polarization of the world? The question is not whether it will be bad for the world economy, because it will be bad, but just how bad. Data compiled by the Netherlands Bureau for Economic Policy Analysis shows that global trade volume contracted by 2% in the 3 months to June compared to a year ago. 2% may not seem very much, but it is the biggest decline outside a global recession in more than 20 years. There is no denying that part of the story is a global slump in demand for electronic goods. For example, global shipment of smartphones fell 10% in Q2, and shipment of personal computers fell 15%. However, it is difficult to believe that sanctions, trade war, industrial policies, all of them features of the polarizing world, are not having a depressing effect on international trade. We don't need to be able to quantify this effect to know that it is there. We just need to look at prices of tradable goods to know that it's working its way through the global economy. Whether it is because of onshoring or friendshoring, we can be sure that things will get more expensive in a fragmenting world. And that's exactly what's been happening. Let's take prices of consumer durable goods like computers, cars, and refrigerators. Between 1995 and 2000, they went down 20% in the US, once adjusted for quality. If you take a moment to think about it, that's a pretty amazing fact. And globalization was at the heart of it. But since 2020, prices for these goods have risen by 25%. That is to say, in the space of just 3 years, all of the decline in the prices of these goods over the previous 15 years have been reversed. Sure, the initial jump of the prices was the result of the lockdown and the associated disruption in the global supply chain. However, the lockdown is long over, and the supply chain has normalized. Yet prices remain higher than they were before the lockdown. And this is despite the fact that the cost of many raw materials in international shipping having declined substantially from their peak. You might tell me that this is because companies only raise prices and never reduce them. But the fact is that prices were falling for 15 years straight. I'm willing to bet that inflation will be lower today if it weren't for the fragmenting world. Jerome Powell, the chairman of the Federal Reserve, pointed out in his speech at the Jackson Hole Economic Symposium last week that there is evidence that inflation has become more responsive to labor market tightness than was the case in recent decades.
In addition, there is evidence that inflation has become more responsive to labor market tightness than was the case in recent decades.
He did not postulate why this might be the case, but this is exactly what we would expect given the backlash to globalization. This is because as countries reduce their dependency on imports, they have to produce more of what they used to import. This means that production capacity at home, including labor market conditions, will have a bigger impact on prices. Powell didn't have to spell it out for us, but it is very likely that prices and inflation in the new global economic equilibrium will be higher than we are used to. What is the big deal about higher inflation, you may ask? Well, high inflation will lead to higher nominal interest rates. More importantly, high inflation will likely lead to higher real interest rates, especially during economic expansion. If central banks can no longer count on globalization to help them keep inflation low, they'll have to tighten monetary policy more to keep inflation in check. This will have two negative effects on economic growth. One, we can expect an increase in the frequency of recessions. Interest rate increases are responsible for most post-war recessions. Globalization, by helping to keep inflation low, meant central banks could afford to gradually take away the punch bowl during economic expansion. This helped moderate the boom-bust cycle, in turn reducing the volatility of financial markets, not to mention term premium in the bond market and equity risk premium in the stock market. We should expect real interest rates, term premium, and equity risk premium to go up in the new economic equilibrium. 10-year US real yields recently shot up to their highest level in 15 years. Two, higher real interest rates mean lower potential growth rate. Higher real interest rates, by driving up the cost of capital, will reduce investment that is the foundation of economic growth. But there is an even more sinister side to the story. Because interest rates have been so low for so long, much of the world, from rich to poor countries, has been on a borrowing binge. As a result, the level of indebtedness has increased dramatically. Higher real interest rates will place a tremendous burden on highly leveraged countries, as they will have to spend a greater share of their income on servicing debt, as opposed to investing in their future growth. Which countries are the most leveraged and thus the most vulnerable? If we look only at government debt, it is clear that Japan, Italy, and the US have the highest general government debt as a share of their GDP among the G20 countries. In comparison, government liabilities in Russia, Saudi Arabia, and Mexico are very low. But it would be wrong to just look at government debt. When we look at non-financial corporate debt, France, China, and Canada lead the G20 countries as being the most leveraged. In contrast, Argentina, Indonesia, and Mexico are the least leveraged. What about household debt? Well, households in Australia and Canada and Korea are the most heavily indebted. In contrast, households in Argentina, Turkey, and Saudi Arabia are the least indebted. When we add up both public sector and private sector debt, a clearer picture emerges. Japan, Canada, and France have the highest total debt to GDP ratio, while Indonesia, Mexico, and Argentina have the lowest total debt to GDP ratio. By the way, the chart makes clear that China has about the same level of total debt as the United States. Before we declare the winners and losers, we need to take into consideration the fact that rich countries generally have more debt. This is because being rich, they can also afford to take on more debt. And because they're rich, they can borrow more easily and more cheaply than poorer countries. In this chart, I have ranked indebtedness relative to per capita income. As you can see, indeed, rich countries like the US have more debt than relatively poor countries like Indonesia. The dotted blue line on the chart is the regression line for the countries in our sample. It allows us to figure out which countries have more debt or less debt relative to their per capita income. Countries that are above the dotted blue line have higher debt than countries with similar GDP per capita. Countries that are below the dotted blue line have lower debt than the countries with similar GDP per capita. By this measure, Japan is the most indebted, followed by China, Canada, and France. On the other side of the ledger, Saudi Arabia is the least indebted, followed by Turkey, Russia, and Mexico. And where is the US? Interestingly, the US sits exactly on the blue dotted line. What it means is that the US debt level is not excessively high relative to this income, at least compared to its peers. High real interest rates will hurt everyone, but it will hurt those that have the most debt, like Japan and China. The fact that Japan and China are running current account surpluses means that at least they're not so dependent on foreign savings. But nevertheless, these countries are likely to face huge headwinds in the years ahead. It is reasonable to think that the Japanese yen and the Chinese RMB will be weak currencies for the time to come. The million-dollar question is, will countries with less debt take advantage of their relative favorable position to take the lead in economic growth and financial market returns? I like Mexico's chances, but the next Mexican president needs to deal forcefully with soaring crimes that reduces Mexico's attractiveness as an investment destination. I also like Saudi Arabia, even though the burden of proof is still on Mohammed bin Salman, who wants to diversify the Saudi economy away from fossil fuel. I also like Russia. Russia has low debt, diversified mining resources, and a large industrial base. Should it win the proxy war in Ukraine, my bet is that it will be in a strong position to take a bigger slice of the global GDP in the years to come. This may give the US and its allies, of course, another reason to want to see Russia defeated in the war. But that's another story altogether. If you got something out of this program, please hit like and subscribe to my free YouTube channel. Let me know what you think by posting your comments on the video. If you want to learn more about my investment strategy, come visit us at davidwunbound.com.